Hey everybody, this is Jason Ostrowski, and welcome to another edition of the Everything Real Estate Podcast. I know it's been a while since we've released a podcast, and that is because, unfortunately, I guess it was my time to get COVID. And having gotten COVID, I can tell you it is not very conducive to a podcast and good audio when you cannot stop coughing. So, with that said, we are back. I'm excited to be back. And today we are going to talk about a very pressing issue that we've all been dealing with lately. And that, of course, is the impact that the rising interest rates have had on our real estate market. You can almost see in real time the impact that those rates have had on both our buyers and our sellers, because I think our mindset has started to shift that we're kind of not in the same market anymore. We're heading somewhere new. And as agents, we have to be prepared to respond to where we're going in the market. So with all that said, I thought this would be a great opportunity to have an expert on mortgage rates on the podcast this week. So we're going to talk to Mark Anselmo. Mark is the area sales manager for Prosperity Home Mortgage. He oversees roughly 60 mortgage sales reps in Prosperity Home Mortgage, which allows Mark to get a great overview of what's happening out there right now in the marketplace. So let's get right into it with Mark, and we're going to pick it up on the other side. All right, so today we're here with Mark Anselmo, and I got to tell you, Mark, I have never heard more hand-wringing and more consternation in the market from agents than right now. And that's because interest rates are rising. They have been rising steadily, and I thought you would be the perfect guest to come on today. So, Mark, how are you?
I'm great, Jason. Really appreciate you having me on the podcast here, and happy to talk about some interest rates and talk about what's going on in the mortgage market. And hopefully, have a positive spin on this, because I think there's some things that are happening in the market that will help us. So thanks for having me.
Yeah, for sure. And yeah, I think we all have to put this in perspective, right? Because we've been used to and conditioned now for years of rates being so low that we think that it's just going to stay that way forever. And eventually nothing stays the same, right? Everything has to change over time, and everything is cyclical on top of that. So I thought our conversation today, starting off, I want to kind of get to the basics of where we are, why we're there, and where we go from here, right? So the first thing I had read, I think an email went out last week through Prosperity that the Fed raised the Fed funds rate by 0.75 of a point last week. That was the largest increase since 1994. So with all of that said, let's start with the basics and the mechanics of why the interest rates are rising and what is the driving force behind the mortgage rates increasing right now.
Yeah, great question, Jason, because there is some confusion there when the Fed raises the rates and how that correlates to what we as realtors and mortgage professionals care about, which is what are our fixed rate and ARM products, which we can also talk about because they're becoming a little bit more popular these days. What is the Fed doing with their rate and how does that correlate over into our world? The Fed controls, when the Fed raises the rate 0.75%, that's controlling more short-term interest rates. That does not have a direct impact. So for example, the day they raised the rate 0.75% last week, our rates actually were flat and actually maybe slightly improved because our market's already baked these increases in, over these last few months. So I guess to go back about 7 months. So 7 months ago, the rates were a 30-year fixed rate was 3%. Fast forward to today, we are at, let's say, give or take 6%. There's some days that they're a little bit lower, some days a little higher, but on average, we're around 6% on a 30-year fixed. Over a 7-month period for rates to go up 3 full percentage points and essentially double I've been in the business 18 years, never quite seen it happen that quickly. We've obviously been in rising rate environments before. So to your point, nothing we haven't seen before. But that is a lot in a short period of time. And, those Fed increases are already baked into that 3%, if that makes sense. And actually, the Fed will meet again next month. They're probably going to raise their short-term rates again by 0.5 to 3/4, which again, we feel is already baked into our interest rates. So there's no need to kind of panic or overreact when you see that Fed announcement, because again, that has already essentially occurred over the last number of months in our mortgage rates.
And why do those rates occur? I mean, we talk about inflation, right? But when an interest rate goes up, can you talk about why that is and how the economics work with rising interest rates?
Yeah, and that's the driver. That's the word, inflation. That is why rates are doing what they're doing. I mean, the Fed is trying to essentially slow the economy a little bit to bring inflation down. Inflation had its highest reading in, I think it was 42 years just the other day, since like late 70s, early 80s. We haven't seen inflation like this. So think about it that inflation is the enemy of low interest rates. Rates have to rise when inflation rises. And inflation's been fairly low over the last number of years, which is why one of the reasons why our interest rates were so low for, really a long period of time. I mean, rates have been low for about 5 years. So we haven't seen this in quite some time, in terms of a rising rate environment. But the inflation is what matters. Moving forward, that's the key. If inflation continues to rise, the rates are going to continue to rise. If inflation, through these interest rate increases, if inflation starts to level, there's a lot of economists and a lot of people that do it for a living think that we're pretty much at the top now, which would be good news. And if we start to see it level and we even start to see it come down a little bit, that's when I think we're going to get a little reprieve with our interest rates.
Yeah, I think it's going to be, and that's actually one of the questions that I'll get into later about kind of where you think we're heading and where your best prognostication about, what the future holds in terms of the interest rates, both short term and maybe long term. But I want to put some historical context to this, because I think we all know agents that will tell us, well, back when I, started in real estate, the rates were 18%, and that is true. I mean, rates go up, rates go down. I know when I started, I've been in the business probably about 15 years. Rates, I think, were in if I remember correctly, low sevens or even mid sixes, around that. I think they were in the sixes. Let's just say they were in the sixes. But historically speaking, can you talk about, let's just say the past 40 years, where do these rates kind of fit into where we've been historically?
Yeah, so we're still actually a little bit under the average interest rate. If you want to go back to about a 30 or 40 year snapshot, these rates are not high. And obviously we've been conditioned over the last, again, 5-6 years to say they are very high. But you know what? A lot of our buyers are in their 20s and in their early 30s, and they haven't seen, the type of interest rates that some of us may have seen 10, 15, 20 years ago. And the other thing I'd note there too is when the rates were incredibly high in 12, 14, 18%, obviously, the average loan amount was much different back then as well. So the impact of these rates increasing, as well as home prices increasing over the last year and a half, 2 years, it's kind of a hit from both sides. I mean, you have a buyer that started in the marketplace a year ago, looking, and the rates were 3%, and that price was say $300,000, and now you're at 6%, and that price of the home might be $350,000. It really does impact the payment. But historically, we're still in a comfortable position with interest rate. And there are some things that we can do. I kind of touched on it earlier with adjustable rate mortgages, and also paying points. And those are a couple of things that have a very negative connotation. And they've had a negative connotation over the last 5 or 6 years because they really haven't been necessary. You could get a 30-year fixed rate with no points at 3%. You really didn't have the need to do anything differently. But in this environment, we see a lot of clients wanting different options. And so what we do at Prosperity is give a few different options. There's no right or wrong. It really depends on the individual's, how long they think they'll have the home for, what their future goals are. But we do have some products that have lower interest rates than the 30-year fixed, like an ARM that's say fixed for 7 years. Because odds are, rates have increased the way they've increased, they're obviously going to come back down. Might take a year or two. We can talk a little bit more about that. But maybe they take a loan that's a little bit more short term to have a lower payment now and then refinance out of it in a few years. Or look at the investment in paying a point to lower the rate. So for example, 1 point is 1% of the loan amount. So let's call that loan amount $300,000. It means the borrower will pay a $3,000 cost to lower the rate, but that might bring the rate from 6% to 5.5%. And over time, that's really going to save them a lot of money on their mortgage payment. So there are some things that we can do to bring that rate down a little bit more. But to answer your question and to loop that back in, this is about an average rate, and we've just been conditioned, over the last, I'd say 6 or 7 years, to think that they're a lot higher than what they probably are. So
we've definitely been very spoiled the past few years. But you're right. I mean, I think that the biggest concern, always from my standpoint right now, is just affordability. If the prices are reaching these historic heights, and then you have the interest rates now on top of it, it just makes that affordability pretty tough. So you kind of touched upon a bunch of areas that I wanted to talk about. And the first thing is talking about the different types of loan packages right now. So for instance, I just had a listing that we're putting under contract today. It's a higher priced listing relatively. It's in the 800s. So I had a couple of potential buyers switch over to jumbo loans. Now they could have done conventional, just a 30-year fixed, but the rate was actually better on the jumbo for them to get into that product in order to save them money. So we talked about ARMs a little bit. Can you talk about just what's out there right now that kind of makes sense from an interest rate standpoint? You talk about rates potentially coming down again and they could refi out of those things. Are there any other loan packages that we should be aware of that maybe we want to look into for our clients?
Yeah, great question. So, when we say, hey, the rate's 6%, that's your conventional 30-year fixed rate. But there's a lot of different ways that you can go from there. And again, just condition over the last 5-6 years, that's kind of all you've needed. It's been so low. That was kind of the end of the conversation. Now we're really talking our clients through a variety of different options. So let's talk about a few ways. I touched on 2 of them, but there's a little bit more on how we get those, rates a little bit lower than what you might see as that 6% 30-year fixed. So the first you just touched on is a jumbo loan. So a jumbo loan is any loan amount over $647,200 loan amount, not sales price, loan amount. So strangely enough, even the fixed rate on a jumbo is cheaper than a fixed rate on a conventional. You would think the opposite, and actually a while back, it used to be opposite. Normally, jumbo used to be a little higher. In this market, the jumbo rates are a little bit lower than the conventional rate. So strangely enough, yes, if we have a buyer that in that $800,000-$900,000 price range and they want to put X amount down, that puts them into a conventional loan, we might actually give them a comparison on, hey, if you finance a little bit more into a jumbo loan, you're actually going to have a lower interest rate. And I would say that rate on average is trending about 1/4 to 0.5% lower, fixed rate to fixed rate, right? Jumbo versus conventional. Then number 2, you can get into the ARM products. I'd say the most common ARM products are a 5-year ARM, a 7-year ARM, and a 10-year ARM. And what that means is that rate is fixed for that certain period of time. A 5-year ARM, the rate will be a little bit lower than the 7-year and typically a little lower than the 10-year. But you obviously have a longer period of time of it being fixed, obviously in those longer terms. But that also is going to bring your rate down, fairly substantially. Another 0.5%, give or take, depending on the day. The other thing just to note is the market is very volatile. So pricing is just. Sometimes the ARMs are priced aggressively, and then you come back 2 days later and the ARMs are closer to where the fixed rates are. There's a lot going on in the background that is making it so volatile that literally pricing from day to day can vary. But the ARMs have certainly been a way that a buyer can drive down the cost, and a lot of buyers are starting to take advantage of it, especially if they think they're not going to live in the house for that 5, 7, 10-year period. They're probably going to move. It's more of a short-term home. Or B, a lot of people understand that we're in a rising rate environment, and most likely within 5 years, 7 years, 10 years, the rates are going to come back down and they'll be able to refinance out of it. The third way is the points, which we spoke about. We have a lot of buyers trying to buy down that interest rate, and we do an analysis of this is what it costs you. This is how much it's going to save you in your payment. You're going to break even on that investment of a point or a point and a half or half a point or whatever that they want to do after X amount of time. Do you think you'll be in the house that long? So a lot of times when you pay points or a point, on average, let's just say the recuperation time is 3 years, right? Like you're going to recuperate your point with the lower payment in 3 years. So we simply ask, do you think this is a long-term home? If it's a long-term home for a buyer right now, I think it certainly makes sense to look at that. And then another way is the 15-year. It's a little tricky these days with affordability, as you mentioned a few minutes ago, with prices higher and rates higher. But if a buyer can afford the payment and has an income level that supports that, the 15-year loan generally runs about 0.75% lower than a 30-year. So we've had some clients opting, instead of a 6% 30-year, let's get down to 5 1/8 on a 15-year. Higher payment for that client, but lower interest rate. And if they can afford the payment, might make sense to do. So variety of different ways that you can go right now. And again, it's all about educating that buyer up front on all their different options.
For sure. I mean, you have some great options in there. And just to kind of follow up about the points, right? If I pay a point, which is 1% of the sales price, what do you see traditionally the impact on the rate? How far does that bring the rate down usually? I know that's case by case basis, but what do you see that doing?
On average, 3/8 to 0.5%. So if you're at 6% and you want to pay a point, odds are you're going to get to about 5.5 to 5.625. And you're going to analyze, what that savings is. So, give or take, if on a $300,000 to $400,000 loan, it's going to bring your payment down anywhere between $70 and $100 a month. Might be an investment worthwhile as long as that client thinks that they're going to be in that home for at least a few years. But traditionally that's going to bring it down anywhere from 3/8 to 0.5 for 1 point. You can do multiple points. Sometimes people do 0.5 point and get it down 0.25%. So there's different. It's not that 1 point is the only option. We've seen clients actually, most recently pay about 2 points to get it down close to a full percent. You can do that as well.
Yeah, if that's your forever home. Even not your forever home, if you're there for 10 years, I mean, to me, it makes a lot of sense. I know that I've paid, I think, 0.5 point in the past for certain items to bring the rate down a little bit. It made a lot of sense for me. It probably makes a lot of sense for a lot of buyers right now. So what would you say to the buyers out there? Maybe they're renting right now, and they have aspirations of home ownership, but they're anxious about the interest rate increases and they may be on the fence about buying right now. What case would you make for them to buy right now? And what case would you make for them not to buy right now? What do you think in your mind that is?
Yeah. So, to buy right now, I mean, it's obviously the old adage. I mean, obviously when you're renting, you're not building equity in any way, shape or form. So it's less thinking about the interest rate and more thinking about long-term financial stability and how you're going to build your net worth and build your assets. And of course, over time, listen, we've seen this before. Over time, it's clearly proven you're going to increase your wealth by home ownership, by building equity in a home. Whether you're paying 6%, 3%, 8%, you're still building that equity. You're not giving all your money to your landlord. The other thing that I'd say too is, we've obviously been in this situation, and I'm not on the real estate side, but just looking from the outside looking in, where home prices have gone up a lot. But what makes us actually feel really good, one of the things that, we hear, and I'm sure you hear, is, oh, well, our price is going to come back down. And if I buy a house today, in a year from now, what happens if we lose 10, 15%? Ironically, when we're in high inflation environments, prices generally hold. From an and actually they generally appreciate. Now, we've seen a lot of appreciation in the last 2 years. So you might know better than me in this regards of appreciation, but the fact that inflation is high actually will most likely protect a buyer coming in today from from the mark, from a depreciation in price. As reasons not to buy. Hey, listen, it's obviously much more expensive today than it was 9 months ago. I completely understand. We have buyers, that are saying, hey, look, I think I want to just hold off. I want to see what happens, with price, see what happens with interest rate, maybe reevaluate it in 6 months or 12 months. And it just comes down to, in my opinion, obviously just that monthly affordability. I mean, if you've gotten to a point where it's just uncomfortable, you're not going to sleep well at night knowing that you have that mortgage payment. Maybe it isn't, right? Maybe you do wait a little bit to see what interest rates do and what prices do. But, obviously we hear all the time. I mean, rent is going up as well. So, there's not too much of a safe haven unless you're living at home, you're a first time buyer and living at home with mom and dad, then maybe it makes sense to play it out a little bit. So it's a lot to navigate, especially for a first time buyer. A lot of empathy there because of how much has changed over the last 6 to 12 months for sure.
Yeah, it certainly has. And yeah, the rental prices continue to increase. It's something that we don't talk about, I think, enough is that, we talk about just pricing in general, but rental pricing is out of control. So it always makes sense if you can buy to buy as opposed to rent. And you talk about appreciation, and I want to talk a little bit about that as well. I want to see what you're seeing out there in terms of the appraisals. And are they, coming back kind of historically in a place where, okay, we have this many homes that aren't appraising, this many that are? Is it kind of near the average, or are you seeing more homes right now not appraising just because of the appreciation that's taken place the past few years, in particular, since the pandemic has started? What are you seeing out there in terms of appraisals?
Yeah, great question. And it's funny, it's so regional. I mean, there's, so our footprint is New Jersey, Pennsylvania, Delaware, and there's certain pockets that tend to have a higher average of low appraisals than others. But, just speaking from an average perspective, in a normal market, you typically run about 5 to 7% of your appraisals that come in below the sales price, that have that sales variance. That's a normal market. There were times, yeah, I'm sure, Jason, you had a few of them yourself, clients yourself with appraisal situations. But there were some pockets over the last year and a half where low appraisals were running closer to 20%.
Wow.
And some 25% in some areas, because we were in this absolute crazy time where, of course, it was, I'm not worried, a buyer saying, I'm not worried about the appraisal, I'll bridge the gap. We just want to get into the home. So that was on the high end. Most recently and trending over the last few months, we've definitely seen that number come down substantially. And what we've seen more on average is running about 12 to 13% low appraisals. So about half the amount than what we probably saw, say, last year. Not quite to that normal market. My personal opinion is I think we're kind of more in a normal market come third, fourth quarter of this year, to where we probably get back down to that average 5 to 7% of appraisals that end up, short of sales price. So have come down a lot, not quite to the average, but we anticipate we see that pretty soon.
Yeah, I didn't know it was that high in certain pockets. Like, that's incredible, because I can't tell you how hard it is to do business in that environment, where you have to constantly be sweating the appraisal. And I know and that actually is leading me into my next question for you. Because I think one thing from an agent perspective that we kind of, or at least I do, kind of get, or I used to get a little confused over, is if somebody is doing appraisal gap protection, let's say, and the property doesn't appraise, and my buyers are putting 20% down on the property. Can you talk about what they can do, kind of shifting things around with the loan, as opposed to bringing, say, extra money out of their pocket? Because I think a lot of buyers get concerned if they're saying, okay, we'll do $25,000 in appraisal gap protection, and then the property does not appraise and it comes in short, let's just say $10,000 short. Their fear is that they're going to have to bring $10,000 out of their pocket to the settlement table. Can you talk about what they can do to modify kind of their loan in order not to do that if they're putting, say, 20% down on a property?
Sure. They do not have to bring another dollar to the table unless talking about a conventional loan, 95% financing is normally the max, right? So if that house underappraised for anywhere between 1% less than they thought to 15% less than they thought, there are plenty of options. Once you get, over that 95% threshold, it would be a requirement to have to bring more money, but 99 out of 100 times, that's not the case. Normally, if you have an appraisal that comes in a little bit low, it's normally, to your point, it might be 10,000, it might be 15,000. It's normally not hitting those type of thresholds. So yeah, they don't have to bring another dollar to the table. Now, of course, there is the impact of mortgage insurance. So, otherwise known as PMI. Anytime you're not putting down 20%, now that buyer might say, wait a second, I am putting down 20%. The PMI is based off of the sales price or the value, whatever is lower. So in this instance, and what we've seen, of course, commonly over the last 18 months, it's been the fact that the appraisal is lower than the sales price. So now the loan to value, how a lender looks at that loan to value, is loan amount to appraised value, because that is what has come in lower. So let's just say in that hypothetical example, instead of being an 80% loan to value, we're at an 85% loan to value. That appraisal came in 5% less, came in, $10,000, $15,000 less, whatever your sales price is. They don't have to put another dollar down. Now, we do have to confront the PMI situation. There's a couple different ways to confront the PMI situation. The first is, you pay PMI monthly. If you have a good credit score, and again, you're at 85% now, it's going to be relatively inexpensive. On a $300,000 loan, it's probably $30 a month. Not necessarily ideal. Nobody wants to have $30 more a month, but that, or hey, you need another $10,000 or $15,000 to the table. In most cases, that's something that a client would probably opt to say, you know what, I'll pay the $30 a month. It does drop off in a couple of years. Once you get back down to that 80%, it's not a long-term thing. But there's also two other ways to avoid it. You can avoid it through a slightly higher interest rate. It might be 1/8% in interest rate. It might just be $10 or $15 a month on their payment. That obviously stays with you forever unless you refinance. So some people like to opt to just pay the PMI because they know they have that lower rate forever and that PMI will drop off. And the third way is you can buy the PMI out as a cost. Might cost, again, in this example, $1,000 in a cost to buy out that PMI up front. That way there's no PMI and there's no increase in the interest rate. So it's going to have a subtle impact to either the payment or the cost structure, one way or the other. But again, it saves a buyer from needing extra money or having to come up with extra money. And typically that impact to the payment, again, is not ideal, but not necessarily a deal breaker that's really going to put somebody out of their comfort zone.
Yeah, I just want to kind of reinforce that fact, because I think from an agent perspective, when we do the appraisal gap protection, I think, the buyers do get very scared. And I think we have to let them know, listen, chances are you're not going to have to bring that money out of pocket. Here are your options. I had a client last year who fell short on their appraisal by, I think, $10,000. I think they had to pay an extra rate where you said like right around $30 a month. Yeah. In PMI for a year until they got back to basically the 80% loan to value, and then they could get rid of it and just move on. And that was a much better scenario than having to bring that money out of pocket, obviously.
Yeah. So $360, which is what that costs for a year. Yeah. Or, hey, I need an extra $10,000. I mean, but most people are going to opt for the $360 over 1 year for sure.
Yeah. So I just want to make that clear to the agents out there that maybe are confused by that is the case. And you talk about, credit score. And I know there's different programs require different credit scores. FHA is different from, say, a conventional. What is the optimal credit score just to get the best interest rate? Just, off.
So typically 720 plus. On a conventional loan, how it works with conventional. And actually, I might go off your script a little bit here. I did want to talk about FHA for a moment. I don't know if that's
please.
Script or not. But because I think that as agents, we need to start thinking about government loans a little bit more. FHA loans have not been able to win an offer, generally speaking. So I'm going to touch on that in a moment. But to answer your question, typically 720 and above is going to get you your lowest interest rate. And what conventional does is it hits the rate slightly in 20-point increments below that. So if you're between a 700 and a 720, the rate would be a little higher. Then if you're between a 680 and a 700, the rate would be a little higher. 660 to 680, so on and so forth. Now, typically when you get into the mid sixes, you're probably going to shift more towards an FHA, because FHA does not have those hits to the credit, with the credit score to the interest rate. So once you start getting, if you're talking a 640, 660, 620 type credit score, you're going to actually have a substantially lower rate with FHA than you would with conventional. And the PMI also, the conventional PMI also increases in those same exact buckets. So, the FHA PMI would be a little more expensive for somebody who has, say, a 720 credit score. But if you have a 620, 640, 660, now it's a completely different ballgame. I did want to touch real quickly on FHA, because sometimes I think, especially amongst the market as a whole, there's a lot of there's a negative perception that it has such a greater negative impact on a buyer who's FHA than a buyer who's conventional. And listen, there are some nuances, but generally speaking, there's really not that much of a difference. I think we're going to be entering a market in the third and fourth quarter where you're going to start to see more government FHA, when I say government FHA, VA type buyers out there, because they have not been able to really win offers in the last 18 months. And there's really not that many differences. It's funny, I was talking to an agent, as part of a agent discussion yesterday, and one of the questions was like, can you even close an FHA loan in 30 days, or do we need 60 days? And there's still like that thought process. I mean, there's no difference in time frame. We can close an FHA loan in 2.5 weeks like we could a conventional loan. There's a little concern around the appraisal, but typically the only difference between an appraisal on an FHA and a conventional is very cosmetic. So, for example, an FHA appraisal might call for peeling paint, where a conventional might. FHA is going to look a little bit more at safety on an appraisal. So if there's a railing down a staircase missing, FHA might say you need it, where a conventional might not. There might be a couple little nuances, but it's nothing dramatic on an appraisal that completely derails the transaction from one to the other. So the last plug I'll give here as we kind of shift into that market. Prosperity has a buyer advantage program. I'm not sure if every agent's aware of it. Most are. What we do is we underwrite the loan up front. So, before they put in an offer, you have a commitment, a full commitment that, conditions for title and appraisal. So as we move into this market, I just wanted to plug that, because it's my belief that if we do an FHA buyer advantage, where you already know that buyer is committed, you don't have to worry about, because again, the perception sometimes is they might have a lower credit score. There might be something there. We've already underwritten it. We have already approved it from a credit standpoint and income standpoint. So if you take that and you couple it against a conventional pre-qual, where all somebody's doing is running their credit, they're not verifying income, they're not verifying assets, I believe that FHA buyer advantage commitment is just as strong, if not stronger, than a conventional pre-qual. So just wanted to mention that, because I do think we're going to start to see a little bit more of that going into the third and fourth quarter. I
was actually going to mention that because I recently had the buyer advantage done with one of my clients. It actually helped us to get the property. They weren't putting a lot down, but they were already pre-approved. They were underwritten. I had a commitment I could pass along and explain to the agent on the other end, hey, listen, this is what's going on. We closed pretty quickly. I think that's the other thing with this is that, you can cut down the time frame for closing if they're already gone through, the underwriting process. So it's a great, great program in this market. And I'm not just saying that because Prosperity's obviously our in-house lender, but it's a fantastic thing that you guys are doing for us. Because it won me an offer right off the bat.
We've heard many stories like that. So what we do, just so everybody understands the process, call it a clean conventional deal where, again, there's, we can generate a pre-qual in 20 minutes like we normally do. So Jason, if you bought a buyer to me and I pre-qualified them, I'd email you that pre-qual in 20 minutes. So you have that if there's something urgent you want to put an offer in. But then what we do to the side is we start working with the buyer to get their documents in, the pay stubs or W-2s, whatever we might need to submit the loan to underwriting. So you still have your pre-qual, you can still put in an offer whenever you want. But when we get that documentation back from the client, when we submit that loan to underwriting, we'll have it committed within 24 to 48 hours. So generally speaking, it might take us a couple of days to get everything from the client. Within a week, we'll have a mortgage commitment for you that is to be determined on the address, and then you can use that for your offer.
All right. Before we get out of here, We touched upon it earlier. I want to ask your opinion. What happens the remainder of the year in terms of interest rates, and where do we go from here into the future? Let's just say next year. Where, in your opinion, are we heading interest rate wise?
Yeah, a question that we're receiving a lot of, and obviously, of course, nobody can exactly predict what's going to happen. There's so many variables. There's so many things that can occur that could completely change things. However, our position right now is, can rates move a little bit higher? They could. Again, if I say 6%, could they go to 6.5%? They might. Could they go to 7%? I don't think so. I would think that would be maybe the very top of where they could go. But generally speaking, I think the good news is we've already seen the majority, if not all, of the increases. There's a school of thought that thinks that, again, with all these increases, it's to get inflation in line. And so once inflation gets in line and starts to, again, level and then maybe decrease a little bit, which we think could happen within the next few months, there's a school of thought that thinks the Fed, is being a little too aggressive, and raising rates a little too much, too quickly. Again, I personally think it's necessary to curb inflation, but of course, it's always a reactive situation, right? So there's going to be a point where it's going to feel like inflation's in line and rates are too high. So when that happens, we think rates are going to come down a little bit. Are we going to hit levels of 3% again in anywhere in the, say, next couple of years? Maybe not, but I think it's reasonable to say if rates top at, say, 6.5, it's reasonable by, middle end of next year to 2024, the rates are maybe somewhere in between. Maybe they're not at 3, but maybe they're at 4.5 again. Maybe they're at 5, but they're at levels that probably aren't going to be this high. So I do think the good news is I don't think we have to worry about rates going up to 8 or 9% here. I don't think that's going to happen. Could they move again another little bit leg higher before they really level and maybe start to decrease a little bit? That could happen. So yeah, that's kind of I think the overwhelmingly positive message is, listen, we've seen the worst of it. We've already gone up 3 full percentage points. That's a lot in a short period of time, and that's going to be the bulk of the increase most likely.
Do you think, just an add-on question to that, do you think that there's a tipping point that we could reach? You see obviously the mortgage applications coming in, the refis or lack thereof. Is there a tipping point that you think percentage wise, interest rate wise, for a buyer where there's been a precipitous drop off in terms of the application? So you had mentioned, like, if we get back down to, say, 4.5%, I think obviously buyers can live with that. Sure, would they want 3%? Absolutely. But 4.5 is something you can live with. Is there something that the buyers can't live with? Is it that 6.5? Have we already reached that point where we've seen applications go way down?
Yeah, I think we've started to see that happen a little bit as we've hit that high 5-6 range. I think when we went from 3 to 4 to 4.5 to 5 to mid 5s, we were still okay. As we're kind of getting into the 6% territory, I do feel like there are a little bit, we have seen a little bit of a decrease in applications. I do think there's some that, what we talked about a little while ago. Let me wait this out a little bit. Let me wait 6 months. Let me wait a year. I'm getting a little uncomfortable with the way things are going. I think that is happening. I don't think it's happening in droves. I still think because there's an inventory issue still, there's not a lot of inventory. That's actually going to work in our favor, as weird as that sounds. There's still going to be enough buyers out there to sap up the inventory, which is completely different what it was, back in 08, 09 in the financial crisis. There's so much inventory and there were just no buyers. The good news is while this has probably discouraged some buyers, there's still a lot out there and there's not a lot of inventory. I think, yes, if we start getting into the high 6s, which may never happen, but if we do, and especially closer, if you start seeing a 7, I think that really scares a lot of people away to say, hey, look, we're waiting. I personally don't think we're going to get there. My personal opinion, which doesn't mean much because I actually thought we topped out at 5.5. So whatever. But I think we're going to start to see inflation really, now that the Fed has put in these increases really start to level. I don't think we're going to see that, 6.5 to 7 range. I think we're going to kind of top out here in the low 6s and then start to maybe trend down slightly. But yeah, we're in that gray area at this point, I would say, in terms of, buyers starting to put the brakes on.
Well, I think if we go above 7, I may have to start buying property in Bitcoin, so
That's right.
See how I do with that. I know that's becoming more of a popular thing. It scares me to death, but I know out on the West Coast, they're buying property in Bitcoin. I just think it's the craziest thing ever. But
that's wild.
You never know what the future holds, I guess.
That's right.
Anyway, Mark, thank you so much, man. This has been very informative. I think there's some great information in there for our agents to kind of sort through in this podcast. So I appreciate your time. I appreciate you coming on and explaining it all to us.
Jason, thanks for having me. Really appreciate your time. It was a pleasure. Take care.
That was the interview this week, and I thank Mark Anselmo for coming on the podcast. Some great information there. Here's a couple takeaways that I had from my conversation with Mark. Number 1, nobody has a crystal ball as to where mortgage rates are heading, but by our best guess, there is some good news that rates probably are nearing their peak rate now in this cycle. Assuming that we don't have runaway inflation, those rates are going to kind of crest and maybe go back down a little bit over time. So Mark does not think that we are going to get above 7% as far as the interest rates go, which is great news for us in the real estate industry and for our buyers. And speaking of our buyers, that leads me into my next point, is that we have to put this into perspective for our buyers, right? We've been conditioned now in the market to think that rates are going to be in the 3% range, sometimes even the 2% range, forever. And they're not. And everything is cyclical. And just because rates have gone up a little bit does not mean that, number one, they are high considering our historic average, which is a little bit more than what they are right now in the past 30 years. And number 2, hopefully your buyers will have a chance to refinance at some point, a couple years down the line when rates start trending downward again, which we think they're going to. So it's not all gloom and doom. And historically speaking, we are actually below the historical average of interest rates for the past 30 years. And my last point is that be prepared for changes. Nothing ever stays the same, and you can kind of see in a marketplace, we are kind of shifting past the peak of our previous market now. We're heading into a new one, and a market correction is not necessarily a bad thing, and interest rates are one of the drivers to change the current market that we're in and head into kind of a new space here. And so as agents, we have to adapt to the new marketplace, whatever that is. And so you may have to shift your marketing strategy, who you're marketing to, what your target market is. If you have buyers that have been sitting on the sidelines because they didn't want to get involved in this crazy market, you may want to reach back out to them and say, hey, look, we may be in for a shift here in the marketplace. Now's a great time to jump back into the market. And on the flip side, on the listing side, you may have to think about your listing strategy. I know a lot of us have come to the strategy where we put the house on the market late in the week. We have showings through the weekend. We review offers the next week. Well, we may have to prepare our sellers that it may not be that way anymore. So always be prepared for change. And it looks like a change is coming down the line if we're not there already. Well, that's it for the podcast this week. I thank you for listening. We'll be back in another couple of weeks with a new topic, a new guest. And as always, if you want to hear a topic that we haven't covered yet, please reach out to me, jason.ostrowski@foxroach.com. And if you like our podcast, please subscribe and leave a review. It helps us to reach more people. This is Jason Ostrowski once again saying stay safe out there, stay selling, and we'll catch you on the next episode of the Everything Real Estate Podcast.